they're still having the question, what is interest volume?
Mm,
So if you just want to take your liberty on
sure.
explaining what we should have been explained to back in high school, right? Back in elementary school, could you please teach us, teacher, what is interest volume and why should we even care?
Good point. Well, first of all, it's great to be back. I certainly appreciate the opportunity to be a guest about a month or so back with your channel. So it's a real privilege for me, CJ. Thank you again. And I think I would introduce one point of, I guess, clarity, but as opposed to there being a correction to perhaps what was discussed or what's been, you know, talked about at previous times, is not so much a correction, but a clarification or further clarification. Okay. So there's a couple of things. One, I'll say relative to what we probably should have learned in high school, we'd probably need about 15 different programs to be able to talk about that one. I think the list is long and there's a lot of things that we learn that are valuable, but let's be honest, there's a lot of things that fundamentally affect and impact the average consumer, the average family that we simply don't talk about. So I'm going to begin before we even delve into the deeper conversation relative to interest volume, effective interest rate, things of that nature. Let's just talk about a couple of basic things, which is the time value of money, right? Just some basic things like the banking rule of 72. Super simple. A lot of people, well, let me not say a lot. I think there are a number of people that certainly have some familiarity with it or have heard of it. But the vast majority of people, even those that are somewhat familiar with it, couldn't actually tell you specifically or replicate what that looks like. So let me start there so I can give some context to this conversation. It's something that I learned early on in my life, obviously in my late teens, and I taught my daughter when she was probably about 10. But it basically states that if you take any interest rate and you divide that number by this formula of 72, or you make it divisible by this factor of 72, it'll tell you exactly how many years it takes to double your money at a given interest rate, right? So if it was 3%, like has probably become more common in a typical savings account today, right? That means it's going to be every 24 years that your money would double. If it was at 6%, say what you might get in an insurance contract or other longer term investments, right? It might be 12 years, right? If you add maybe a 12% interest rate, 6 years. And if you take 18%, which would be very difficult to earn, but we certainly all know where we're paying it in the form of credit cards, et cetera, although unfortunately, in this day and age, a lot of credit cards are 20, 25, 30%. But even at 18%, that means the money's going to double every 4 years. So the whole point is understanding the time value of money, the compounding effect of interest. Now, I set the stage with that because there's always a very common, and forgive me for using this expression, but very common inaccurate vernacular used to describe these topics. And by that, I mean, it's not even only so much compound versus simple interest. Yes, there are, in fact, vehicles where that's true. There are loans, in fact, that are structured in a way that are even using simple or compound interest. But we speak about mortgages and other vehicles. That's not necessarily the appropriate vernacular. It's more so representative between open versus closed end interest, which leads us to say that interest volume, well, let's double back. Interest rate or the note rate on a given loan, let's say a mortgage is a perfect example. When you have a 2 or 3 or 4 or 6 or 8% interest rate, it's really the note rate, right? By that, we mean the contract rate of what you're going to be paying and so forth. So as a result of that, it simply means your payment is simply predicated on that interest rate. Now, APR is really just a function of disclosure. We talk a lot about that. Banks require it for lots of reasons, or regulators do, but it's really the cost, the upfront cost associated with setting up that loan factored into an interest rate for disclosure purposes. So you might have a 4% rate, but your APR is 4.365 or something like that. So APR, again, is only relevant for comparative purposes and for disclosure purposes. But note rate simply determines your payment. But what determines interest volume? And by that, I mean the amount of interest you're actually paying to support that debt service is different. And by that, we mean what percentage of a payment, a given principal and interest payment you make, is actually going towards interest versus principal.